Hello, and welcome to today's episode of Smart Investing. In this episode, we will unravel the mysteries of an advanced stock market strategy known as pairs trading. This fascinating strategy is all about identifying two stocks that are tightly hitched together, moving in tandem due to their robust correlation. It's like two friends who always show up at the party together. Where you see one, you're likely to see the other. But how does this help us as investors? Well, we can leverage this correlation to our advantage. By taking positions in both stocks simultaneously, we can profit from their price differentials. Imagine buying a ticket for the friend who's likely to arrive at the party first and selling a ticket for the one who tends to lag behind. The difference in their arrival times is where our opportunity to profit lies. So, that's an overview of what pairs trading is. Sounds interesting, right? Now, to make this concept more tangible, consider the example of Tata Motors and Mahindra & Mahindra. Both are substantial players in the Indian automobile industry, often reacting similarly to the same economic factors and industry trends. Therefore, they often move in sync, their stock prices reflecting a strong correlation. Imagine you've observed over time that Tata Motors' stock price tends to rise faster and fall slower than that of Mahindra & Mahindra. In this case, you might decide to buy Tata Motors stock, betting on its continued strong performance while simultaneously short-selling Mahindra & Mahindra, anticipating it will underperform. If your prediction is correct, you'll profit from the widening gap between these two stocks. However, if Mahindra outperforms Tata Motors, or if both stocks fall but Mahindra drops less than Tata Motors, you'll face losses. This is why pairs trading requires careful analysis, monitoring, and risk management. So by closely observing these two stocks, one can leverage their correlation for potential profits. Wondering how to execute this strategy? It's simpler than you might think. You start by identifying two stocks that have a strong correlation. Once you've done that, you'll want to buy the stock you anticipate will rise and simultaneously short sell the one you expect will fall. This is where the pair in pairs trading comes from. You're trading two stocks as a pair, each one balancing the other. Let's go back to our example of Tata Motors and Mahindra & Mahindra. If you predict that Tata Motors is going to outperform, you would buy Tata Motors and short sell Mahindra & Mahindra. When Tata Motors rises and Mahindra falls, you'll profit from the difference. The key here is to act when the price relationship between the two stocks deviates from their historical norm, and that's how you execute the pairs trading strategy. But remember, it's not without risks. Before you dive in, there are some considerations and risks you should be aware of. Pairs trading is no magic bullet. It requires careful selection of stocks, diligent monitoring, and a robust risk management plan. First, the two stocks chosen must have a strong historical correlation. This means they should typically move in sync with each other. If the correlation weakens, the strategy may not work as expected. Second, it's critical to monitor your positions closely. This isn't a set it and forget it strategy. Market conditions can change rapidly, and it's essential to adjust your positions accordingly. Finally, risk management is paramount. All trading involves risk, and pairs trading is no exception. You should have a plan for what to do if the trade goes against you. This might involve setting stop losses or using other risk mitigation strategies. So, keep these tips in mind to navigate the waters of pairs trading safely and successfully. Pairs trading can be a sophisticated strategy, but it also opens up a world of opportunities. We've ventured through the world of pairs trading today, exploring its mechanisms and potential advantages. We've seen how identifying two correlated stocks and taking positions in them simultaneously can lead to profit from their price differentials. We've also looked at a real-life example using Tata Motors and Mahindra & Mahindra, two Indian automobile giants whose stocks often move in sync due to industry trends and economic factors. However, as we've emphasized, it's not a walk in the park. Choosing stocks with a strong historical correlation monitoring positions closely, and having a solid risk management plan in place are all vital components of successful pairs trading. Remember, practice makes perfect. So do your research and practice with paper trading before you dive into the deep end with your hard-earned money. Until next time, happy investing!